Hello and welcome to AI Market News by LM. Before we jump into today's deep dive, just a quick but essential note for our listeners. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. And crucially, this video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, welcome to the deep dive. Today is Wednesday, October 29th, 2025. Based on the prepared resources, we're seeing a bit of a contradictory picture in the financial markets globally. Our mission today is really to give you a structured, concise summary. We'll focus on the US and European markets, key currency pairs, the big central bank action happening today, and, well, the enormous risk that seems to be sitting just under these record equity highs. So let's unpack that right away. US equity markets. They've hit all-time highs again. And it's frankly hard to talk about this rally without immediately pointing to big tech, isn't it?
Oh, absolutely. That's been the story for a while now.
The benchmarks just reflect it perfectly. Look at the S&P 500. It's trading near, 6,890.89, up just shy of 0.25%.
Mm-hmm.
But the NASDAQ, the heart of tech, that's leading the charge, up 0.80%, near 23,827.49.
Right.
Even the Dow Jones is getting pulled along, advancing toward 47,706.37.
And a lot of that pre-market optimism today, Wednesday, is because we're bracing for those huge earnings reports after the close, right?
Yeah.
Microsoft, Google Alphabet, Meta.
Exactly. The whole market is kind of holding its breath, hoping for confirmation that the good times will keep rolling.
Well, what's undeniable really is the engine here. It's the artificial intelligence rally. I mean, look at Nvidia shares.
Yeah.
They were up nearly 5%, 4.98% to be precise in recent trading. The market's effectively betting these record highs are justified because, well, the AI revolution's maybe just getting started.
So investors are just shrugging off any talk of an AI bubble.
Seems like it. As long as these massive revenue numbers keep coming in and we see expansion into areas like quantum computing, the enthusiasm remains incredibly high.
Okay, but when a rally gets this narrow, this fast, we have to talk psychology, right? The fear and greed index, that's our usual check.
We could look at it. The theory's simple. Too much fear pushes prices down. Too much greed pushes them up, maybe unsustainably.
And right now?
Well, based on its components, it's flashing a significant degree of greed, particularly that stock price strength component.
Yeah.
The sheer number of stocks hitting new 52-week highs versus lows.
Which is basically all those AI and tech names we just mentioned.
Exactly. So it confirms this isn't some broad-based economic boom lifting all boats. It's very much a specific sector rotation driving these indices.
That's a really crucial distinction. And when we look outside the US, that narrowness, it becomes a real worry. Take Japan. The Nikkei 225 also hit a record high recently, 51,307.65.
Yes, but here's the kicker. Analysis show the huge advance was concentrated in only 43 constituent stocks. Just 43.
Wow, that's fragile.
It's the definition of fragility. If global AI optimism pulls back even a little bit, you see how vulnerable those concentrated gains really are. And honestly, the US market is running basically the same playbook, betting the farm on a handful of earnings reports tonight.
Okay, that's structural fragility. It ties perfectly into our next big theme today, central banks. Because if the U.S. market is running hot on just tech steam,
then the rest of the economy, the old economy, probably needs a boost.
Which brings us squarely to the Federal Reserve. Their interest rate decision is due at 2:000 p.m. U.S. time today.
Yeah, this is a critical pivot point. Even if the outcome feels, predictable, market expectations, you can see them clearly tracked by FedWatch, are pointing very firmly towards a rate cut.
What's the consensus?
The consensus expects the new target rate to drop from 4.25% down to 4.00%. Now, some analysts are calling the meeting itself boring because the market seems to have fully priced this cut in already.
Okay, but wait. If it's already priced in, how does that help the market? Doesn't that limit the upside, remove the Fed's power to surprise? Why do we still care so much about the nuance today?
That's a great point. It matters because the market isn't just pricing in this cut. It's already looking ahead, determined to price in more cuts before the end of the year.
Ah, okay.
So the conversation isn't really about if they cut today, it's about the language, the statement, the press conference, anything that signals the pace of future cuts. If they hint at a faster easing cycle than expected, that could add fuel, especially for those non-tech sectors that really feel the pinch of borrowing costs.
Right, the rate-sensitive parts of the economy. Let's see how this expectation is playing out in currencies. Take USD/JPY, the dollar yen. It's hovering around 152.24, maybe 152.28.
Around there, yes. And sentiment is incredibly cautious. Options volume actually hit a one-month low.
Great.
Investors are just hesitant. They're refusing to make big bets before they hear from the Bank of Japan tomorrow and before they get the Fed statement later today. Nomura International, they're pointing to a key resistance level around 153.30.
So if the dollar breaks above 153.33 against the yen?
That would be a signal, yeah. It could suggest renewed upward momentum for the dollar there.
Okay, and what about the euro? Euro USD is trading around 1.1645. Is the expected Fed cut giving the euro a lift?
But the euro is holding relatively steady. Generally, yes, an expected Fed easing should put some downward pressure on the dollar, which tends to support the euro. But, the bigger currency story, maybe the more dramatic one right now, involves the yen, but from a different angle.
How so?
It connects to these massive global capital shifts we're seeing. Japanese life insurers, these are huge players. They control something like $2.6 trillion in assets.
2.6 trillion. Wow.
It's enormous. And they are actively pulling back from foreign bonds. They're reducing those holdings and significantly increasing their positions in JGB's, Japanese government bonds, yen bonds.
Why the shift now?
Well, two main reasons. Domestic rates in Japan, while still low, have become relatively more attractive. And maybe more importantly, the cost of hedging currency risk on their foreign assets has become persistently high. So holding yen assets is just less costly and complex right now.
And the impact?
A sustained move like this, by such a massive pool of capital, it has the real potential to disrupt global bond and currency markets. It basically pulls huge flows back towards Japan and Asia.
Speaking of Asia, that brings us neatly back to the Bank of Japan. Their monetary policy statement and rate decision is tomorrow, October 30th.
That's right. The rate itself is widely expected to be held steady at 0.50%. But just like with the Fed, the focus isn't really on today's number, or rather tomorrow's number in this case.
It's the forward guidance again.
Exactly. Investors will be parsing every word for clues about the pace of future hikes. That's the main thing determining whether the yen finds a floor or continues its long slide. The BOJ is trying to walk this incredibly fine line normalized policy without derailing the domestic economy. It's tough.
Okay, let's shift gears a bit. We need to look at the backdrop. The non-AI market risks simmering away. Geopolitics is always there, isn't it? President Trump's Asia trip is a big factor this week.
Definitely influencing trade sentiment.
The main event is that high-stakes meeting scheduled with China's President Xi Jinping on Thursday. What's reportedly on the table?
Two potentially major economic points are being discussed, based on reports. First, tariffs. There's talk of potentially lowering them, maybe from 20% down to 10% on some Chinese goods.
Contingent on what?
Contingent on cooperation from China regarding fentanyl flows. Second, and this ties right back into our tech theme, is access to those advanced Nvidia Blackwell chips.
Ah, the really high-end AI chips.
The very same. If the U.S. were to agree to allow sales of those top-tier chips to China, that would be a huge market mover, and frankly, a very sensitive potential concession.
We'll watch that closely. And we can't ignore the Middle East either, unfortunately.
No, the latest news out of Gaza is worrying. Israel ordering forceful strikes against Hamas, which puts that U.S.-brokered ceasefire in real jeopardy.
So regional stability remains uncertain.
Precisely. Which means commodities, especially crude oil, remain volatile, and something investors need to keep an eye on, even though prices have been sort of steady after falling for 3 days recently.
Okay, let's cross the Atlantic. European corporate news. We're seeing some pretty solid Q3 results from major banks, despite underlying economic worries over there.
Yes, some strong numbers. Deutsche Bank, for instance, their fixed income trading revenue really beat estimates. Came in at 2.48 billion euros.
That's impressive.
It is, up 19% year over year. It gives them a nice tailwind as the CEO prepares to announce a new strategy on November 17th.
And UBS also had a strong quarter, but their CEO, Sergio Armati, he seemed to be on the defensive.
That's right. He was dealing with some legacy issues, mainly from the Credit Suisse takeover. He had to defend the bank's exposure to failed companies like First Brands, basically calling the criticism a witch hunt. And maybe more importantly, from a financial perspective, he stated very clearly that UBS bears no liability regarding that Credit Suisse AT1 bond ruling.
Okay, the AT1 bonds. Remind us why that ruling is so significant.
Right, it's highly relevant. It stems directly from the Credit Suisse collapse last year. The Swiss regulator made that controversial decision to completely wipe out about $17 billion worth of these specific bonds. Additional Tier 1, or AT1s.
Which wiped out the bondholders.
Completely. Caused a massive global uproar. So when UBS took over Credit Suisse, those bondholders started looking for legal ways to claim liability from the newly merged bank. Ermati's statement confirms UBS is fighting those claims aggressively and apparently winning, which is crucial for their financial health and stability moving forward.
Got it. That makes sense. Okay, to wrap things up, let's quickly look at the economic calendar using investing.com as our guide here. What are the immediate high-impact events left for today and coming up?
Sure. So for today, Wednesday, October 29th, the market's already seen some data like the goods trade balance. Still to come, we've got new home sales and pending home sales at 10:00 a.m. U.S. time, then crude oil inventories at 10:30 a.m. But the absolute main event defining the day is that Fed interest rate decision at 2:00 p.m.
Followed by those critical earnings after the close.
Exactly. Microsoft, Google, Meta, huge.
And then tomorrow, the focus shifts firmly back to Asia, right?
It does. Thursday, October 30th, is packed with high-impact Japanese events. We get BOJ Governor Ueda speaking, the monetary policy statement itself, and the interest rate decision.
And we're looking for
any language changes, anything that might hint they were going to accelerate their hiking schedule, that will definitely move the USD-JPY pair and could impact those global capital flows we talked about.
Okay, so stepping back from the details.
Yeah.
What's the big takeaway here? The tension you mentioned earlier.
Yeah, I think it's really that tension. On one hand, you have this incredibly resilient U.S. new economy, right? Driven by AI, big tech, pushing indices to these record highs, but also creating serious concentration risk. But then the main policy response we're expecting today, the Fed's rate cut, it's primarily aimed at supporting the traditional old economy, those broader rate-sensitive sectors that are actually lagging behind.
So it raises a pretty profound question for investors, doesn't it? Can the Fed actually ease policy enough to lift that old economy and broaden out the rally?
Without just pouring more fuel on the fire, without dangerously inflating the already, let's say, exuberant new economy.
It's a very delicate balancing act, and how they manage it will likely define market direction through the end of the year.
Absolutely. A lot riding on the next few days.
Thanks for watching. Don't forget to like and subscribe.